Do you remember back in February, the governor of the Bank of England said this?
I'm trying to get into people's heads and ask them not to ask for too high pay rises.
Well, broadly, yes. I will say that.
People weren't very happy with him for saying that. The chairman of the Federal Reserve, Jerome Powell, took a bit more of a sensitive approach and hinted that wages were growing at a pace not consistent with their inflation target. But he didn't explicitly warn against pay rises like Andrew Bailey did, but he was more or less saying the same thing. But since inflation is now at multi-decade highs, surely it makes logical sense for wages to rise as well. So why don't central bankers want this to happen? Take a look at this chart. This is the price of oil, and we can see that it fluctuates up and down over time, although in recent times it's been accelerating upwards. And if we look at gas, we see a similar situation, or food prices, or many other commodities. But look at this chart showing wage growth. Do you notice the difference? Well, it doesn't really show those big fluctuations in the same way. It tends to adjust much more slowly and usually moves upwards. This is what we'd describe as being sticky. Unlike something like oil prices that easily adjust up or down based on supply and demand, wages have a slower response because workers resist pay cuts. So this means that wages are an important factor in making inflation more permanent. It can also mean that wage rises lead to more inflation, which then requires higher wage rises to allow for the cost of living, which leads to more inflation, and so on and so on. A situation otherwise known as a wage price spiral, which can really be tricky to get out of. So what does history tell us about wage inflation? Well, there was a paper that was recently published which found that since 1955, there have been 8 periods where wage growth was above 4% and at the same time employment was below 5%. And can you guess what happened within 2 years of each of those periods? A recession followed, every single time. Central banks may be able to change monetary policy, but they can't do things like print more oil or semiconductors to fix supply problems. But they can attempt to address wage growth, and they'll probably want to do it before the inflation becomes entrenched. But how do they do that? Well, by doing exactly what they're doing right now, raising rates and cutting stimulus, which will slow the economy. And what happens when economic growth slows or the economy flips into a recession? Well, typically that results in an increase in unemployment as people lose their jobs. But the piece of data that the Fed may want to target are the job vacancies, which are at record highs at the moment. If they can reduce the number of job vacancies, then wage growth should also slow down because there will be less demand for labour. The Employment Cost Index, one of the Fed's favourite measures of wage growth, is running at about 4%. Historically, when wage growth hits 4.5%, that's when inflation accelerates and a wage price spiral begins. Now, if we also consider that productivity is slowly increasing, theoretically, companies can avoid passing on increased costs to consumers, at least to a certain extent. So right now, the Fed could possibly argue that wage inflation isn't yet entrenched, and perhaps just slowing the economy somewhat could be enough to slow wage growth, and that could achieve this so-called soft landing for inflation that Jerome Powell has referred to and that we discussed in the last video. Click up there to watch that. Now, one Goldman Sachs economist suggested that slowing growth to around 1 to 1.5% would decrease the job vacancy rate, which would reduce the job workers gap, and finally, that would slow wage growth. It's a big if, but if they can manage it, the Fed would avoid inflation becoming entrenched, since most of the remaining causes of inflation are still temporary, and it's at this point that they may start to relax on their rate hikes, even though headline inflation may remain somewhat higher than target inflation. But if they fail to slow wage growth, then the Fed may have no other option but to induce a recession to forcibly prevent it from becoming entrenched, even if it doesn't slow the inflationary pressures from the supply side. And this outcome would more likely be a hard landing. It's this entrenched inflation that needs to slow before the Fed can really start thinking about backing off from their tightening. The paper by Alex and Lawrence shows a significant slowdown in economic growth is very likely given the situation being faced, which to me sounds a lot like a hard landing. And speaking of hard landings, if you could land your finger hard onto the like button for this video, it would be really greatly appreciated. Thanks so much for watching. I'll see you in the next one.